increase in inflation, due to things like supply chain interruptions, sort of stuff like that. But as we moved into the fall, people realized that there was some more persistence to it, and it's pretty clear. And I'll show you lots of pictures about this. That the expectations for when the Fed will intervene, what they'll do, how they'll do it, have been moved up basically. Now, it's not totally a bearish story, because I'll show you some other examples of how the market may be feeling right now as they moved up the intervention. Kind of like the long-term outlook for stability seems to have been improved a little bit, and there's evidence of that in how various markets have repriced. So, looking at it from the top level, because all these markets, all these participants, whether it's on the financial side or the corporate side, have to try to interpret things like this. They have to come down with a judgment on what it means for valuations and also, of course, volatility. And the one thing we want to talk about, although it's kind of as an open question, is like there are plenty of other examples where we've been in the runway towards tighter policy, right? Are things different right now? Do we expect different things to materialize as we begin the path right now compared to, let's say, what things were like, in prior instances of, beginning a cycle of overall more tighter monetary policy. Okay.
Well, hold on, Leon.
Yes, Andy, go ahead.
Let's talk about some of these themes.
Please go ahead. Absolutely, Andy.
Inflation. The Fed all through all of 2021 was telling you inflation was transitory. We kept pounding the table that it wasn't, that things are getting out of hand. They told you that, it's okay if we overshoot our 2% inflation objective, and maybe we get to 2.5%, or at the outside 3%. Well, we've been at 7% on the CPI the last 3 months, and it doesn't look like it's going down anytime soon. We've had PPI over 9%, and it's a worldwide thing. Today, German inflation was out there, CPI was 5.7, and 2 weeks ago, the German PPI was up over 19%. So, you've got a real bad supply chain problem. They tell you supply chains are going to get better. They're going to get better. Well, Barron's had a good article this weekend on someone that does a lot of satellite looking at infrastructure, looking at shipping ports, looking at trucking stations, looking at trains. The supply chain's not getting better anytime soon. This inflation is going to be with us for a while. And the Fed missed it. They had plenty of opportunity of which to start making moves in the middle of last year, and they didn't do it.
Question: were they saying it was transitory based on some idea that the COVID disruption would be also more transitory than it has been?
Well, that's certainly a good point, but I believe that they were saying that they felt that inflation was going to be a temporary phenomenon. If you want to define transitory as a 5-year as a 5-year window, that's one thing. But they were defining it in loose terms, and looking at it like it would be 3 to 6 months that things would change, and they never altered that. And it doesn't look like it's transitory at all, and it's going to be with us for a while. And these are some of the biggest numbers that we've seen. Looking at the list of people that were on this call a few minutes ago, I'd say half of them weren't born by the time we had this kind of inflation back in the early 80s and the late 70s. So, no, I would say that the Fed had no idea what they were talking about as to whether it was supply chain related. They did more recently, or how quickly it would reverse. So I think the Fed missed a window there, missed an opportunity, and now they're so far behind the curve. And now we had what I would call the Fed pivot at the Fed meeting on December 15th, where all of a sudden, where people were talking maybe 1 to 2 rate increases in 2022, now they're talking 4. We even saw Bob Michel of JP Morgan Asset Management yesterday being interviewed, and he talked about the potential for 8 rate hikes this year, which is not going to happen. Other people are talking about 50 basis points moves in March. I don't think that's going to happen. But I would tell you what will happen. At next week's Fed meeting, they will accelerate the taper even further. Whereas originally they moved it when they did it originally in November, it was supposed to end at the end of June. When they changed it in December, and when they changed it to December 15th, it was supposed to end the end of March. Now, I think next week they're going to change it, and I think it could end right then, which they would call leaving it, what was this term Citibank used today, cold turkey. But I tend to think it's going to be more towards the end of February. And that's going to give them optionality of which to raise rates in March. And I think eventually start reducing the balance sheet, which could alter the amount of rate increases that we see in 2022. So I don't want to get too far away from this, but I think a lot of people, I think most of the Fed governors missed it. The two that seem to have it right, were Kaplan and Rosenberg. And unfortunately, those two guys had insider trading type issues, and they were gone from the Fed a few weeks after that was announced. But most of the Fed had missed it totally. And now everyone has changed their viewpoint. Even Kashkari is talking 2 to 3 rate increases. And he's been the most dovish of the Fed governors, at least in my opinion, over the last 2 years. So Leon, go ahead, unless there are other questions.
Any other questions? Yeah, I mean, it seems to me that we sort of believed most of last year that they were going to pull back on the bond buying program, and until they got to a steady state there, then they were going to initiate tightenings, right? Well, we've totally thrown that out the window, right? They're going to happen simultaneously, right? Then also the question is, well, if you pull back on how much you're buying, does that mean you still reinvest proceeds from the mortgage portfolio, right? In which case the balance sheet size doesn't necessarily go down because you're redeploying the principal proceeds back into product, right? But it seems to be pretty clear. I mean, from what you're saying, Andy, if they're actually going to try to end the bond buying process within the next handful of months, then the next step is going to be deliberate reduction of the balance sheet by just selling paper into the market, right? And we're going to talk a little bit about that as well.
I think their reinvestment, I think they'll cap their reinvestment. And, we've seen, you asked me this morning, Leon, what do I think, what's happened with this new Fed tightening that is really starting to kick in. And, in the last month or so, IG spreads are out about 20%, given using the CDX, and high yield spreads are out more like 14%. They're still holding in a bit. But one thing I noticed that since Black Friday, mortgage spreads have widened out 30%, where the 5-10 blend, which Bloomberg quotes daily, has gone from 63 to 90 this morning. And I haven't seen where it ended up tonight, but I'm sure it's even wider. So according to my trading desk, who's more active in the mortgage market than I am, they expect it to go to 100, 105. So that's in pure anticipation that the Fed will cut back mortgages even more so as far as reinvesting goes.
Right. We're going to talk about that a little bit later in this presentation.
Very good.
Kind of like try to sort of identify where we are right now, what's the consensus view, and both what would you think kind of like hypothetically that you do to valuations of, let's say, credit or corporate or whatever, and then what actually has materialized up to now. So we will talk about that. Okay. So I'm sorry. I just lost.
That's me, huh? Good picture, Leon, huh? Thanks.
Okay. So what are the themes here? Okay. So as I said in my preamble, what we want to talk about is how do the professionals like Andy and a little bit like me, think about the rates markets, the interaction between, financial drivers, economic drivers, monetary policy intervention drivers, right? How did these things change when we had this, massive impetus of generating liquidity that emerged with the pandemic in the first quarter of last year? And then under normal circumstances, what do people look at to figure out where all these related assets, whether it's credit or mortgages, structured product, the dollar, equities, whatever? I mean, what signals do those markets take from what's going on in rate space? Now, there's kind of a normal consensus view of how to do this, but we want to know how much were these old rules stressed and maybe made no longer that applicable because of what we're coming out of, so to speak. And so that's one of our themes we want to talk a little bit. And then there's some optimistic view that maybe we might leak a little bit wider in valuations, right? But maybe the fact that the Fed is more on the ball right now, telegraphing their actions, The economy is is fairly running on pretty strong cylinders as well. Will we be bailed out by those two kind of like favorable factors going forward? So that's going to be the strategy we're going to follow in this talk. Okay, so let's review. I mean, Andy sort of mentioned it. I think, well, actually, no, he mentioned the Fed meeting. Here was the December payroll report, the employment report from December, came out on January the 7th. So headline number, the two headline numbers that people typically focus on. Well, there are more than two, I guess. But we had a weak number as far as non-farm payroll increase, went up only 199 when the consensus was 450, right? But that was balanced to some extent by the significant drop in the unemployment rate from 4.2 down to 3.9. You see that over there, right? And there are fairly strong numbers on hourly earnings and so on. So how did the bond market react? So this was kind of one big lump of data that hit the market after we've been leaking wider, leaking softer in value in yields for a handful of months. How did the market react to that? Well, here's what the bond market did. 10-year notes sold up by about 8 basis points. Andy, you want to comment a little bit on how the market responded last month to this month's employment report that was, I guess, week and a half ago, right? Yeah.
Right. So, Leon, go back to the previous slide and let's go through this. So there are a couple of things here to note. I mean, I think everyone on here understands how to dissect the payroll number, but I'll go through it anyway. One of the things that, yes, 450 was expected, 199 was gotten, but there was a 2-month revision of 141. So that's getting you a lot closer to that number. But the key thing is that after the analysis was done, most people came to the conclusion that it wasn't the demand side of plenty of jobs, because there are plenty of jobs out there. It's the fact they couldn't find people to take those jobs. I believe that we're at full employment now, and I think the Fed is starting to come to that recollection. 3.9% unemployment rate certainly gives you a number there. Originally, the Fed thought full employment was at 5%, then they moved it to 4.5%, then they moved it to 4%, and they're probably at 3.5% right now. But I believe that the unemployment rate is such that if it's not already there, it's approaching 3%. And the number of quits out there are at astronomical levels, and the amount of jobs outstanding are at high levels. And that we're starting to see in the hourly earnings. Year over year was 4.7%. And as far as and the underemployment rate also came down quite a bit. But we've seen wage inflation running over I believe I quoted this about a week or so ago. Wage inflation is running at 6% annually over the last 6 months, 4.7% over the last year. And we just see this continuing on because there really is a shortage of labor out there. And one thing that Price Waterhouse put out, which I got a kick out of, and I still can't believe, even though they said it twice, that 65% of the US labor force is out there looking for another job. Can you imagine that? 2/3 of the labor force is out there looking for a job. How can you run a company when 2/3 of the employees are out there looking for something else? Doesn't mean they're all moving, but that's just a very high number. And it just tells you that no one is afraid of leaving their job because they know there are multiple jobs that they can get. Oh yeah, okay. The quit rate, yeah, I see where you have it now on this one. So as far as the market went on that particular day, the market backed up, plain and simple. That everyone focused not on the non-farm payroll number, and not on the probably antiquated ways that the Labor Department uses to calculate some of these numbers, but they focused on the full employment aspect of things. And that, I think, is basically how the market is thinking right now. To take it a step further, and Leon, if I'm getting in front of you, just stop me.
No, Manny, fine, go ahead.
The two things the Fed has been concerned about through 2021 is labor and making sure we're at full employment, and secondarily, inflation. They kept mumbling to the idea of transitory, and I don't mean to insult the Fed, and there are probably ex-Fed people on this call, but I think the Fed missed the ball there. And now that you could see at the testimony that Powell gave just last week, as far as his confirmation hearing goes, you can see how the senators are now more concerned about inflation than they are. They're not even mentioning employment. Even Biden today in his press conference, and I only caught a couple of headlines, said that the Fed has to raise rates in order to fight inflation, which is the number one problem. And, will it continue to be the number one problem? No, but in the long term, no, but in the short term, yes. I mean, these are numbers that justify, and we were talking about Salomon Brothers days in the 80s. These inflation numbers are numbers that justify 7 or 8% 10 years, not 1.9 or 1.85 10 years. So you're way behind the curve. Are we going to go to 7% 10 years? No, I don't think so. But we're going to go higher in yield. Currently, that we closed at 186. I can see that the bond futures are down as we're talking right now. 192 I have as near-term support. As you get in that 192 to 195 area, that equates to a 127 on the on 10-year Treasury futures, which right now there's a massive amount, 322,000, I believe, based on the article I sent around today, of puts that have been bought or options outstanding, the majority of which are puts. And I think that's going to cause a swoosh type moment, of which, if it gets executed as we get closer to the February 18th expiration date, I would tend to think that you're going to see 10 years pierce 2%, probably somewhere 204, and if it really gets ugly, 2 1/8. Now, I think it'll probably come back from there because the short base out there right now is very large. But I would say that people are very much prepared for higher rates. The market, I don't think so. I don't think the equity market is quite prepared for these quick higher rates. But you know what? You had the NASDAQ today hit the 10% corrective level again at the close. Right now, the equity market, now it's back down again, in the futures. So I would say that we're going to be into, as Leon mentioned before, we're going to have some tough valuation problems. It doesn't mean that any one way, we're not going to have a crash. I don't think we're going to have a bear market, although we could. But I think you're going to see all the major averages go into corrective territory. Question is, do they stop at 10%? Do they go to 15%? Or do they stop right before 20%? And I don't have the answer for you, at least
Andy,
not today. Go ahead.
You there, Andy? I was going to ask a question. Interesting about, I was just talking about this today about, if you look at the journal today, talked about some of these stocks having huge drops, some of the high price to sales stocks. I'm thinking about, I haven't seen anywhere a measure of how much market value has been lost, because if you look at, let's say, back when the .com crash was, they talked about how much of the NASDAQ dropped in terms of valuation. The thing was, back then, the companies weren't worth, 40, 50, 60 billion. You have companies now that have dropped 50%, which is about maybe sometimes it's 20, 30, 40 billion in market cap loss. I wonder how much, even up to now, if this NASDAQ correction, how much market value has been wiped out. I bet you it could be actually be more now than it was in the .com first few months.
Could be,
very
yes.
possible.
Yeah. It could be because of the difference in sizes, but certainly
because
because
you had companies like DoorDash and stuff, dropping from being worth 100 billion to 40 billion. Robinhood is down 80%. Rivian, but back in the .com days, the companies were worth 4, 5, 6, 7, 8 billion. They weren't dropping from 80 billion to 20 billion.
Great point.
So I wonder if this wealth effect may actually be disguised, because the NASDAQ is only down 10%, but may have much more valuation extinguishment that you had, but you're not seeing that actually.
There's an easy way to ballpark it, is to look at Kathy Wood's portfolio and put a multiplier.
Exactly.
Poster boy for the most sensitive to NASDAQ, basically, right? Yeah.
Well, I mean, that's the extreme sort of speculative names, right? Because NASDAQ is still buoyed by the mega caps, which have held it up pretty well. I mean, right? The major indices are hiding much of the death and destruction beneath the surface, as you pointed out. I mean, we've seen it in our stat arm signals that are already up 20% in 2 weeks. So most of our market neutral signals towards the end of the year went absolutely berserk. I mean, We saw stuff going up 116% by the end of the year. That's up another 20% now, but that's mostly coming from the short side after 13 years of the Fed pumping and, the market's going up, and suddenly we see short alpha. So that's definitely very unusual.
But
And then,
Milan,
and then also, I think another problem too is the fact that portfolios have used bonds as a ballast against stocks. Now the bonds and stocks are operating in the same direction. Yields go up, the stocks go down, So it's a big problem now. There's the hedge no longer works anymore. And probably a lot of algos still are doing that still now.
Well, that was going to be a question relating to risk parity for our experts here. I would love to hear what Andy and Leon think about the implications for risk parity and rebalancing.
I think risk parity is going to go the ways of, again, portfolio insurance.
Portfolio insurance. Well,
it should have gone out years ago, but risk parity somehow held on to its feeble anchoring to the market, but always had problems, and now it's probably going to be even more of like a useless thing.
But you know how I view that though? I mean, it's like the stronger people believe that a relationship holds, even when valuations get out of whack, then the less they're going to believe that it should reverse. So for instance, you could believe that bonds are balanced against equities. Let's say when bonds are 3-handle or 4-handle, whatever, right? But as bond yields are rallying and they still fulfill that function, right, of offsetting, widening or leakage softer in risk assets, right? And the more people see that it continues to happen, even at more and more expensive levels of bonds, they kind of like feel, well, it will just persist, right?
Yeah.
And I'm not convinced right now that if we had a major meltdown in risk assets, whether it's corporates or whatever, you won't get some offsetting benefit if you're long.
Yeah. At some point,
even at 150 10-year yields, I think.
Yeah, probably today you saw some buying of 10 years as the market fell off. So that's two forces on the rates now. It's just by itself. You have an increase by all the Fed stuff, and then you have the market gets too sold off stocks, then you have some pressure. But I think most of the money is leaving stocks and going into cash, not into bonds, right? It looks like.
All right, so I got a lot of questions in front of me from Armand and let's try to break them down a bit. The first one I think is easy. You talked about basically the old 60-40 balanced portfolio, 60% equities, 40% bonds. That clearly is not working. And that has to do by the fact that the Fed manipulated the bond market so low, by basically, controlling it. And when you have the largest buyer in the world not being price sensitive and out there buying bonds, you get numbers that just don't make any sense. None of these numbers we're seeing now, even though they're much higher in yield, 2s through 10s this morning at 3:20 a.m., which was the high yield print of the day, had set records that, pre-COVID, that, you had to go back to early 2020 and sometimes in late 2000 or mid 2019. The only one that is still higher in price, lower in yield than in the last year is the long bond. So, that 60-40 clearly doesn't work, and it won't work. As far as risk parity, that's a tougher one. I really don't want to take that one on because I'm not really sure that some risk parity stuff works. I'm not certain that, the stock market is going to crash. I think it's going to be ugly. I think it's going to be painful, but I don't think it's going to crash. And I do think that the economy is still strong. I saw the Atlanta GDP numbers today, and they're still over 5%. So, so I tend to think that our economy is going to be demand driven with supply shocks and higher inflation, and I expect it to last all year. So, what is it going to be in 2023? I don't know. But the biggest buyer in the world will cease buying sometime over the next 30 to 60 days. And that buyer won't be back anytime soon, or at least I hope not. As far as the wealth effect, that is a real effect. Is the first, Armand's asking me to quantify it. I don't know what we lost. The first trillion, the first 2 trillion, and maybe not so much. But if all of a sudden you send this economy into a slowdown or God forbid a recession, then the Fed's then that means the Fed has moved too fast, too far, which is why I'm discounting all these 6, 7, and 8 Fed increases, rate increases this year, or 50 basis point increases. And if I were to say my net expectation is 4, and if I were to lean, I'd lean towards 3 before 5. Now, granted, the most interesting thing, and I don't know, Leon, if I'm going ahead of you, the most interesting thing is how is the Fed going to balance the portfolio and the reduction? And this is one that I haven't been able to get my hands around yet. I mean, they increased the portfolio from 4.5 trillion to just under 9 trillion now. The question is, what's...
Sorry, Andy, and there's a picture right now. I'm showing a picture right now.
Oh, very good.
Yeah,
okay, so that's your Fed balance sheet. Now the question is, what is the relationship? And I don't think it's a steady one. And this is, maybe Andy Calate might have an idea. What is the relationship for how much reduction or reduction of the balance sheet equates to what in interest rates?
We have a question. Yeah, we have a question there. Exactly. That's our third bullet point right here.
Yeah, right. I'm thinking, does 100 billion equal 10 basis points? Or is it, more like a $500 billion equals 25 basis points? I just don't know yet. The Fed, the part of the Fed that put out this whole idea of balance sheet reduction is the Kansas City Fed. And I read a little bit of what they were saying, but they don't go into detail as to how it breaks down. They just feel in Waller, Fed Governor Waller, I think, is the smartest of all the Fed governors. And given that he grew up in research and now he's a Fed governor, I just think it makes him incredibly valuable. So I listen to everything he says. And he's still, even with all this inflation, he's still talking 3 rate increases and a mixture of balance sheet reduction. And he was the first one to talk about balance sheet reduction. And he might be talking about it as early as the May meeting. So I'm going to stop there for questions, or Leon, for you to take back over.
Yeah, I'm going to talk. We are going to talk a little bit later on.
Quick
I'm sorry. Go
question.
ahead, Martin. Go ahead.
With the reduction, does the rate of reduction have as much of an impact as the absolute size of the balance sheet? Because I would think that a hurried reduction would send a much stronger signal to the market than whatever the absolute level of the balance sheet is.
No, that's a very good point. And I think you're onto something. And I think that's one of the fears that Powell has, that if they were to do the balance sheet reduction aggressively, I think he fears that it would send the risk markets into a tailspin, and it would not benefit the Fed over the long term. There's only, whereas the market is hawkish. Look, we've all been, or half of the crew before, when I had everyone's picture up, half the crew's been doing this a long time. The other half, probably all youngsters. But how many times has the street predicted the Fed's going to raise rates, or the Fed's going to lower rates? They probably have 8 predictions for every 2 moves, or 10 times for every 1 move. So I think the market right now is building in a much more aggressive Fed than we're going to see. And I think we're going to be surprised on January 26th next week when the Fed comes out, and they're not quite as hawkish as people think.
Yeah, I mean, 2 points on that. Right? One is there is some historical perspective on looking at.
Can you
Hello?
please put it on mute, please? Thank you.
Yeah, there is some benefit to understanding how the rate markets were priced before the liftoff of tightening in earlier regimes. I think one concern that I have right now is in some of the prior instances, the rate markets over-adjusted, and people actually made money writing down those forward rates, essentially, because they were sort of buy rates 1-2 years out, and the tightening trajectory didn't get realized, or the trajectory that was implied by the forwards did not get realized, and people made money expressing that view. I don't think that's where we are right now at that point. And I'll show you an example to try to validate that. The other thing, going back to the equity market, is it's funny because I understand, the point you're making about the wealth effect. But what's amazing is if you go back to even, let's say, when the equities were higher a handful of months ago, You had people defending those valuations on fundamental grounds, maybe, in other words, not just certain alternative ways of looking at PEs did not look too expensive, or this idea that, you could validate these high valuations of growth companies because of, not just simply the low rates and low discounting, but other, arguments. So it's funny that we didn't think we were in a bubble. It wasn't a consensus view that we were in a bubble as far as equity or risk valuations a handful of months ago. And now people are saying that even at these lower price levels, there could be serious damage that could be done if the Fed,
Leon, you know Bob Schiller. Maybe you even know him personally. I don't know.
I don't
You
know.
know?
I know of him, of course. Yes, I don't know him personally.
Well, he has what is called the CAPE ratio.
The Cape, yes, exactly, right.
CAPE ratio. I mean, I don't know. The standard CAPE ratio, good CAPE ratio is, and maybe Martin can comment on that, is probably in the low 20s. Last I looked, it was probably in the low 30s, maybe even the mid 30s. So who was ever telling us that market valuations were not rich, they're just blowing smoke, because they're trying to justify higher equity prices that there's no basis in reality, or they're trying to look at it saying, well, based on a 10-year at 1.25 or 1.5, the equity market could be so much higher. Well, we're not at 1.25, we're at 185, and I think we're going to 233. Now the question is, do we stop at 233? And where should equities be then? And I just don't think you can justify the current valuations.
Okay, we'll get to that in the discussion of kind of like where should risk assets be if, let's say, we are in a significantly higher rate environment with more intervention to come. So let's continue. Okay, so let's take a look. The last time we visited a situation where they were going to reduce their I have my brother to thank, Armand to thank, for this graph from the FT. So take a look at this. The last time the Fed announced normalization, look what stocks did. They moved sideways. That's the blue, right? So back in 2000 and was it beginning of 18, we had a weak bond stock market 18. So they decided to pull back on some of the growth in the balance sheet that got launched in the response to the 2008 crisis. And when they announced that, look what happened. We had sideways equity market movement. Let's go back to even 2013.
Well, hold on a second, Leon. From what I remember, and I think this chart is right, but I think the dates might be a little bit off. The Fed started, they told us in 2017 that reducing the balance sheet was like watching paint dry or watching grass grow, or one of those scenarios that they like to saying it's unimportant. But in 2018, it was getting increasingly clear that it was affecting the equity markets. And you literally had a bear market kick in December of 18. Where you had stocks down at 1.20%. And all of a sudden in January, the first week of January in 2019, Powell comes out with Bernanke and Yellen and makes a major pivot saying, we're gonna stop reducing the balance sheet, and and I don't know if he said right then and there that they're gonna start easing again, but they were very concerned. So the Fed knows that mistake. They're not going to make that mistake again. So I don't know how they're going to do it. I don't know if it's going to be a standard thing. I don't know if it's going to be a month-to-month thing. I certainly know they're going to reduce the amount of mortgages they reinvest in from the roll-off. And I think that's what's behind a lot of the mortgage widening that we've seen in the last couple of weeks. But I don't know exactly how they're going to do it, but they're going to be a lot more careful about it than they were in 2017 and 18.
Yeah, well, another example of how, the old rules may not apply. Thank you, Andy, for that observation. Right. Yeah. Okay. So let's proceed then, guys. Okay. So let's dig deep into inflation. Okay. Here's the year-over-year CPI. Andy, you could speak about this at length, of course, but look at it's very, very dramatic, right? A 7 print, the last time it came out, which was, I guess, end of December, right? That's the year-on-year increase in consumer prices. You alluded to PPIs being even stronger, right? Even hotter, right? But, you sort of see it all happened in the, beginning like in the, beginning the second quarter of last year, right? Okay. ECI, which people sort of say is the favored measure by the FOMC. Andy, maybe you could explain why this is viewed to be more reliable by the committee than the CPI, the monthly CPI.
Well, you know what? You really need a diehard economist to get into the bowels of this. But basically, it's a slower moving thing, and it knocks a lot of things out. But you know what? Inflation is inflation, and whether
Also, I think
it's
the main,
go ahead.
yeah, and the main thing about it, the difference is I think it has a little bit of a different composition, and it covers more areas of the economy. So it seems to be that it's a better
Well, I
measure of
think it takes
overall.
out a lot of the housing costs. I don't think it accurately puts in the
Oh, yeah.
rental increases and some of that stuff.
But that's the big problem with not the CPI is that they're talking about how the rental equivalence number is is lagging. So by the summertime, you're going to see a big jump in the rental numbers. And of course, I saw that thing in the Barron's about, they said if you were to put in the housing component instead of the rental, that the housing is up 19% in the last year. Rents are up only 4%. So if you use the housing component versus the rental
Yeah,
number,
you would have been at
Much
double
higher
digits.
number, right? Yeah, right.
you
Yeah.
would have been at 10.5% for inflation. And actually, that was my thesis topic that I wrote about the rental versus housing costs back in 79.
Rental and housing are real costs. You got to live somewhere. You got to
Yeah,
rent
Yes.
somewhere.
and that was
Yes.
well,
whatever.
see, back in the late 70s, the BLS had this beta index that they're putting alongside the CPI with using the rental thing as like a test measure. So my thesis was on that. Like, is that a good change to do, to go from rental to housing? So it turned out I said it was, and then by 82 they changed it to rental from housing. So but that discussion was gone the last 40 years, and all of a sudden it's back on the headlines now. People talking about rental versus housing costs all of a sudden after 40 years.
Well,
Pretty
let
funny.
me get to Leon's question. Basically, you had PCI, and you can see this by your chart for a good number of years at 1.5, 1.75, but basically sub 2. Then you started to grind up a little above 2. For some reason, Leon, I don't believe. I thought that PCI was actually still under 2 going into like
You mean ECI? You mean ECI? You mean ECI?
ECI.
Yeah, right.
Oh, employment cost index. Oh,
Yeah.
all right. So this is
Yeah,
the wage.
that's different.
I see.
That's different. That's not
For some reason, I thought it was PCI.
Yeah.
My bad. All right. So employment cost index, you're above 4%. And look, you're at full employment. People can't get workers. People are pilfering workers from other places. They're offering bonuses. And you know what? And why I think inflation, or another reason why I think inflation will stay, is they're passing these right through to
Consumers. Yes,
to
right.
consumers, and the consumers are paying for
Right.
it,
Yeah.
and they're saying thank you, and they're seeing empty shelves in grocery stores and whatever, and they're happy to get their goods, and they don't care what they pay for them. Obviously, for those of us that have equity portfolios in the last few years, it's not a big deal. But for people that don't have that kind of stuff and haven't benefited from the Fed largesse, it really costs people, which is why you see such a fear now in employment is public enemy number one. Excuse me, inflation is public enemy number one, and employment is just going to continue to soar. At 4%, ECI, and 7% CPI, you're making good money, but you're still not beating CPI, which doesn't mean that you can't live better. But ECI is going to continue to be there. We're at full employment. There's this woman at Jeffries that likes to put out provocative stuff, and I believe she said by the end of this year the unemployment rate will be at 3%. I think it already is at 3%. In fact, I even think it's lower than 3%. I think it's just the way the Labor Department counts it is not catching up. We're at full employment, and you know what? If we're not going to have immigration, and we're not going to be able to bring back people that are retired, what is it? 2.43 million people have retired, or 2.43 million people have retired above and beyond the expectation. Whatever the case may be, there are no people to hire.
Right.
Sorry.
Yeah, exactly. Yeah. Just a side point, then we'll move on. I didn't include, I could have, the deflator I don't know how that's performed though, but I assume the deflator is also GDP deflator has also gone up obviously the last
Yes.
couple of
Yes.
quarters, but I haven't checked.
Yes.
Must be probably a 5, maybe a 4 or 5 handle, maybe something like that. The deflator, I don't know, but whatever. Okay.
It's up to 6.
The 6, okay, deflator, okay. Deflator, though, you don't know, basically that's the measure that the Commerce Department uses when they adjust from nominal to real growth. It's called the GDP deflator. Okay, which I guess the Commerce Department computes themselves, I would assume. Okay, now let's look at the rates markets. Okay, so first thing you look at to try to understand where we are, where we were, where we're going is what do the Eurodollar futures say about the realization or the projection, market projection. So you see it right now. I just sort of showed prices like the contracts. So here's a picture of the curve. So right now we're talking about the market pricing in a handful of tightenings, maybe 4 to 4.5, 25 basis points. We flatten out pretty quickly, right around the latter part of next year. That's where we are right now. Now, some evidence, I think, that the market is kind of like situated a little bit more benignly is this. Even though we've had in the last, since September, we've had both end of this year and end of next year euros. They've sold off. The blue is the December 2022 euros. So they've come off 85 basis points. So the market's discount of where your LIBOR will be at the end of this year is 85 basis points higher than what it was in September. At the same time, you have the following effect. I'm sorry. I'm sorry. I made a mistake. You have the following effect, right? That actually compared to June, right, we have a lower target terminal rate. So this is what the futures curve was in June of this last year. Right now, it's much steeper because the market's discounting a moving up of the trajectory of tightenings, but to a lower terminal rate. Now, is this evidence that people are strengthening their confidence in the Fed, that they'll be on the job? They won't have to raise rates as much because the market will perceive them to be no longer behind the curve as much as they were. Andy, you want to comment on that?
Yeah, I don't think that's the case, Leon. I think right now the Fed's got a real credibility problem, and I don't think anyone's giving you the benefit of the doubt that they're going to get ahead of what they're doing now. It doesn't mean they won't get ahead of it, but right now that's not the interpretation. I think the interpretation is that they're going to over tighten, they're going to do too much, they're going to send the economy in a spiral or maybe into a recession. And I think that they're going to have to come back and bring back some of those hikes.
Yeah,
so I'm not willing to give the Fed, the benefit of the doubt right now.
Yeah, that may be why this gray curve is exhibiting a somewhat lower terminal rate, because people basically say they may overdo it, right?
No.
And they may have to reverse sooner rather than later, like we have other examples in the mid-90s that thing happened. One more observation here. Here are the probabilities based on Fed Fund futures of what's going to happen at the March meeting. So back in December of a month ago, there was only a 40% probability that they would tighten in March. Right now, based on the Fed Fund futures strip, the probability is almost 80%. So right now, the market's predicting with 85% probability, the probability there will be a tightening at the March meeting, which is the meeting after the one that's taking place next week, right, Andy? Is that right? Next
that
week,
is correct, Jerry.
Exactly.
Let me add a little bit here. First of all, there are very few people that think the Fed might actually move rates next week. That's not going to happen. As far as the March meeting, Leon's looking to me, that looks like the CME site, correct?
Yeah, this is from Market Watch, but this is based on Fed Fund futures. Yes.
Right. So I've got up right now the Bloomberg one, which is what I call the WIRP or the WIRP, World Interest Rate Probability.
Right.
And their number of hikes for the March meeting is a little over 1. So that right now, their hike idea is at 105%. So they're not at 80. They're saying you are going to have a rate hike, 100% probability. And
I think this chart is from last Thursday, I think.
Oh, okay.
This chart is almost 5 days old. That's why.
Okay.
All right. Well, Leon, that's fine. I mean, we bring these things up here not for accuracy, but to start a talking point. And as I'm looking at it in June 15th at that meeting, It's 2.36 times. So that gives you a pretty high probability of a June rise. And then the next one happens in September, and the next one happens December 14th. Now, that is your standard thing. Now, do I think it will happen just like this? Of course not. But you know, there will be some choppiness, and there could be, you know, a correction, or it could be the Fed decides to increase balance sheet reduction in such a way as to not raise rates as much, which is what Waller said in late December.
Well, here we are, you know, right now, this is yesterday's close. I just ran this yet last night, and, you know, we're at 138, right, for decent this year. So you add maybe a couple of basis points because this is euros versus Fed fund. And of course, you have, it's a 3-month rate. You're talking about probably, I don't know, four tightenings, I would suspect. Now, the point I made before about the historical, you know, comparisons, there have been periods where we've been on the cusp of a tightening where this strip has looked really cheap. In other words, the market has overcorrected what they think is going to be the schedule of tightenings. And people indeed have made money by betting against that view. Today, I don't think we're at that configuration right now, because I don't think, you know, 98.62, 138 rate is particularly cheap, right? Given what Andy's been saying about between 3 and maybe 6 between 6 tightenings over the course of this calendar year, right? So to me, that's another kind of like a little bit of a concerning situation as far as whether rate markets are priced properly, because we have not over adjusted for the higher inflation and the expectation of a earlier liftoff.
Silly question about this. In September 23, LIBOR will no longer exist. Does that at all influence how the euro dollar futures are trading?
That's a great question. I don't know. I don't know what the ARC has decided.
That's not actually those rates will still be there because there's a fallback provision, so that they're still quoting these LIBOR numbers, even though it's not being used as a current index. They're still being quoted as LIBOR.
Well, let me tell you what I know. And that is that LIBOR will still be quoted. It's still quoted now. I get updated LIBOR quotes every morning. It's going to be quoted at least till June of 2023.
Right.
And what I also put out for my firm every day is 1 month and 3 months SOFR. And 1 month SOFR is still lagging a little bit, but 3 months SOFR seems to be coming up closer. I think it went out 16, whereas 3 month LIBOR went out 25. But you know, I mean, that's basically the credit aspect of it. So,
normally what it is, and normally the has been over the last year that the Fed funds is around, let's say, 0.07, and 3 month LIBOR is like 0.13. So it's like a 7-point spread. So whenever I look at the euro curve, try to deduce the Fed funds, I take the euro dollar rate minus 7 basis points to get the curve, you know. So, but given now with the March contract is going to embed a 25-point increase, the 1 month and 2 month and 3 month LIBOR, there's a big jump, you know, from 1 month being like around 0.13, 2 months like 0.415, 3 months is like 0.25 because the 3 month LIBOR incorporates the
March meeting. Yeah, that's right.
The March
correct.
meeting. So you have like, you know, it's one third of it is at 0.13. The other third is about 0.13. The last back end is at 0.38. And that combination of those 3 rates gives you like 0.25. So,
yeah.
So even though there's no quote for the euros, let's say, assuming that it does, I think that they'll keep it for a while, still even past 23.
Yeah.
The best thing is you just take the euro curve and go -7. That's the Fed funds rate. You know.
Yeah. And by the way, those of you unfamiliar with this, what Armand just said is the calculation embedded here. Right? You basically look at in Fed funds line, you look at the futures contracts, and you look at where the meetings occur in relation to the calendar months, which is what the Fed funds contracts capture. So for instance, if I look, let's say at March Fed funds futures, right? Well, between March 1 and March 16, you'll have one rate, and then if they tighten, you'll have a different rate for the remainder of that month. So the Fed funds contract, which settles at the compounded, no, I think simple average of the daily funds rate for each of the days in the calendar month, will represent that blend of the two rates. So that's the exercise that's done to obtain these probabilities here. Just a little informational point for you guys. Okay, thank you. Let's proceed. Okay, so let's look at so this is the story in the money market, in the euro markets. What about in the bond market? And this is the bond market, twos, tens, twos, fives, tens. We see they've all sold off, but of course we know that twos, tens has come in, which again is not surprising given where we are right now in the expectation of time. You want to comment on just these two graphs here? Bond market
All right,
and
so I
twos,
mean,
tens?
well, leave one. Don't
Okay.
keep switching. Let's comment on one and then the other. So let me just see how each one is here. So the 2 years blue, the 5 year. Okay, fine. So we follow fives and tens very closely because that's we find that works for what we do in credit as well as for my firm. And the 5 years pretty much it took a while, but you know they basically got to 131. And then we felt that once they broke 140, they would probably go, all the way up to 155. And then when they broke 155, we figured they might do a little bit to 1 5/8 because we like eights. And now we think 177 is support. So you got to 169 this morning, and you're probably, I don't have it up right now. I don't think treasuries are trading right now anyway. So I tend to think that the 5 year is probably going to go to 177, and then maybe a little bit higher than that, maybe 190. 10 year is the most interesting because that's the most actively traded. 10 years, once they broke 150, 1 5/8, and they broke 169, and they had a real hard time breaking 170. But once they did, they got all the way up to 180. And this morning, as I said earlier, after the UK inflation numbers came out, the 10 year treasury got to 190. And it closed about 186, and it looks like it's going to open a little bit lower. I tend to think that the 10 year is going to have, get back to 192 to 195. Then I think it breaks and gets to 204, 206, and then maybe 2 1/8, and eventually somewhere between 2 1/4 and 230. And the last one, the 2 years, that's pretty easy. 131. That's our level on 2 years. And looking at the charts, I could actually justify 150 on 2 years, but I'm going to stick at 131 because that's what I think is going to happen. Now the yield curve, it's pretty interesting. Leon has twos, tens, but I'm going to talk about fives, 30s because that's what I follow, and that's what I can talk. So you had a lot of talk fives, 30s that once it got into the 70s, it would probably get into the mid 50s, and I believe it got to maybe 49. And since then, it bounced back up into the mid 60s, and it's been bouncing between 52 and 60. And you would think that, okay, we all know the Fed's going to raise rates. We all know that the raising of rates is going to affect out to the 5 year much more than it's going to affect the long area of the curve. But I think one of the things that the Fed wants to do, one of the things the Fed's concerned about is they don't want to invert the yield curve because that sends an inappropriate and inaccurate idea that we're going into recession.
Yes,
and I think
right.
that's why they started talking about balance sheet reduction. And that's why I think they're going to do less rate increases than the market, than a lot of people in the market think. And I think they're going to use more balance sheet reduction. Again, and the question I asked before, and someone else, and Leon, I guess, asked in the chat too, or in the slides, I don't know what the relationship is yet. 100 billion equals 10 basis points, a half a trillion equals 25 basis points. I don't even know if you can do that because I think that's going to be a moving target. So I'm not sure how the Fed's going to do it, but they're very concerned about yield curve inverting, and they're I think they're trying to jawbone and willing to sell stuff, even though they don't own a lot of stuff in the long end, willing to sell stuff in the long end of which to try and keep the yield curve honest per se.
Yeah,
So,
we even saw, Andy, we even saw in the early 2000s, right? I mean, even Greenspan used the term conundrum, right? They were a tightening cycle, right, after they had eased in the 2000 equity crash, right? And everybody was surprised why bond yields weren't going up. And Bernanke promoted this idea about a savings glut, right? That basically there was money looking for a home. It was going into U.S. bonds, right? And that led to support for bond valuations, despite the fact that we were in the midst of a tightening cycle, right? And they started tightening in June of 2004, and they tightened continuously up to the 07, 08 crisis, right? But while they were doing
Yes.
that, we didn't see bond yields back up, and that's probably one reason why we had this explosion in structured finance and all these complicated asset-backed securities as people were searching for yield, right? In the midst
Leon,
of
we saw this in 2020 and 2021, where they would go out the credit curve. I
right.
mean, we saw some of the most massive moves downward in yield and high yields. I mean, this morning I was quoting, double B's at 385. I mean, high yield itself, I think, was 440, and even triple C's were still under 7%. But there was a point that you just made that I thought was interesting, and now it's escaping me. So, well, I guess we're going to have to. You got to give me a minute to figure out what that was.
Oh, I see. Yeah, no, I was just saying that. What was I saying? I just forgot myself. I'm sorry about that. Yeah. The fact that they embarked on a tightening cycle beginning in June of 2004, right? They were tightening. Bond yields were resisting going up, right? And it set the stage for this massive explosion of securitization to try to seek
Right,
higher yielding
right.
product, right? And it
That
kind of
was
set the
something you
stage
said
for the
right
crisis.
before then, but let me comment on that. This
Yeah.
has been these last few years. Basically, obviously we talked at the beginning of this in kibitzing. We talked about Salomon Brothers. I mean, you'd have firms like Salomon Brothers that would go into an unemployment number, and I don't know, Armand, you want to comment on this? Wouldn't think twice about having $500 million, 5 years, just for a shot. And that is like so far gone away nowadays, because your biggest dealer by far, your biggest market maker by far, has been the Fed over the last bunch of years.
Yes.
You don't see dealers taking big positions. You see, the dealer backed books were discouraged, and basically, pretty much, there's still a few back books out there, but pretty much they stopped having the ability to buy stuff, and they wanted them. The Volcker rule said that they could only take positions, versus customers. Oh, but now I know what I was going to say. As far as interest rates are going to stay lower than one would think, given the current inflation environment, as I said, 7% CPI does not warrant anything with a one handle in 10 years. But what I think is going to happen, what I see happening right now is, and this goes to a question that someone asked in the chat about other central banks. If you're a European, investor right now, I mean, this morning was the first time you had flipped 10-year bunds to a positive number.
Right.
All right. And you got to 2 basis points. They went out negative. That was the first time since May of 14 that you saw a 10-year bunds positive.
I think,
So,
Andy, the low yield was wasn't the low yield minus 0.9%, I think, the low yield?
well, if you had
in
asked
bonds?
me that, I mean, I can look it up, but I'm not going to turn
Yeah.
my focus to my Bloomberg.
Maybe
But
not
yeah.
that low, but it was significantly below zero. That I know
Well,
for
you
sure.
basically, the Swiss 10-year switched 2 days ago and the Bund this morning. But the point being that it is so cheap right now for overseas, whether it be Asian, whether it be European, to just buy U.S. treasuries and, for the carry trade, and, hedge it with dollars or don't hedge it with dollars. Whatever the case may be, you're still going to have a very positive thing. And I think that's going to keep our rates lower for longer. And to answer the question in the chat, the U.S. Central Bank has by far and away the largest balance sheet out there. And I can't compare it to GDPs off the top of my head, but historically the European Union GDP and the US GDP was about the same, with the Europe maybe being a little bit higher. But I think the Fed balance sheet is by far and away the largest, and I see that as the most directional move that we're going to see with central bank balance sheets. The ECB still doesn't want to raise rates, and they still don't want to sell anything, and they say they're going to control inflation. Valerio was out this morning talking about controlling inflation, and he said nothing. I mean, he didn't say how they're going to control inflation. They're just going to jawbone it, So I'm not real keen about that. Meanwhile, the dollar's been increasing in value. I mean, it hit a top in the last few days on the Dixie, but a lot of people try to equate, and this might be a controversial comment for a few people. A lot of people try to equate rising interest rate yields with value of the currency. I think that's a misnomer. I don't think that the value of I don't think the yield level of interest rates is as much of a direct effect on the value of a currency. I think the value of a currency is more directly related to the health of the economy of the country.
Right. Yeah.
And I think it's like an 80-20 type thing. And there's probably other things in there. But I'm not a currency expert, but certainly currencies come into play as to how interest rates move. So so those are 2 points I'm going to make. Big carry trade. We saw the Japanese buying, start. They bought some 10 years this morning as it was hitting 188, 190. I don't know what they're going to do. I still think rates are going higher, but there is a big short base out there, so I wouldn't be surprised to see, a move back down to maybe 1 3/4 and 10 years at some point in the next 7 or 8 days.
Okay, thank you. Okay, let's proceed. Okay, so now let's look again. We talked about inflation, the actual prints. Now, those of you who know a little about this know that there's a very, very important market that gives us a signal for where the bond market is pricing inflation. It's called a break-even, and comparing the nominal yields versus inflation-protected Treasury yields. This is called a break-even. It's simply a raw difference in yields. So we sort of see how it's performed, right? It did jump up, right, significantly since September, but with evidence that the Fed is kind of like more on the case, it has come back down, right? It is still higher than it was. So what this is saying is, based on the price of 5-year nominals, or the yield, I should say, and 5-year inflation-protected bonds, the implied inflation realization for the next 5 years is only about a 2.89%. Now, how do you rationalize
Leon,
that?
you're still on the 2s10s curve.
Oh, I'm sorry.
At least you are on Wi-Fi.
Do you see it now, Andy?
Not yet. No, not yet.
You don't see it?
No.
Oh, I see.
Still on the 2s10s
It says my screen.
curve.
Yeah, it says my 1 second. Hold on a second, please. Yeah, it said my screen is paused. Sorry about that. Okay, do you all see it now?
That's
Implied
it.
break-even
Yeah.
inflation.
Yeah, right.
Yes, I do.
So now, ask a very, very naive question. How could it be that the break-even right now is under 3, with inflation print of 7, possibly heading higher with all these wage pressures? Now, how do you rationalize that? Well, it is over a 5-year horizon, right? So this
Well,
picture,
that's the whole thing is that, the market still thinks that,
they're going to work. It's going to work. They're going to be pushing down. Yeah.
Actually, you'll have a case where you may have deflation if it goes into recession, a bad recession because of Fed cuts. So that's why you're seeing that the break evens are nowhere near what you would think.
Yeah.
And if you look at if you just look at this regular back in the envelope real yield, which is just the treasury minus the 12-month lagging
inflation, right?
Yeah, that's
like incredibly negative.
1.8 minus 7.8. So that's about 6%, which is, and it hasn't been the last time. You said last time that you had that kind of a spread, it said was in World War II, after World War II, right? I mean, that's
because the government had intervened to keep rates low to be able to borrow for the war. Inflation peaked in the years immediately after the war, right? Exactly. Yeah, right.
So I mean,
isn't that what's happened now? I mean, for different reasons. Thank God we're not in a war, but the Fed is just come in so aggressively.
Yes,
and
correct.
bought so much paper. I mean, they're basically buying years worth of refunding. One of the things I saw on Bloomberg Intelligence, which I always think is an oxymoron anyway, but what they said is that the Fed doesn't want to be seen as using their balance sheet to monetize the deficit. And that's one of the things that they want to get out of that business. And that is certainly a good reason of which to reduce. Go ahead.
Anthony, it's all this talk the last year or two about this, modern, MMT,
Yeah, it
modern
failed.
monetary theory, which
Yeah.
which basically, if the Fed does this right now, it sort of debunks that entire, and that was the whole left wing progressive economic angle, was MMT was the way to save you, to just basically print,
Well, think of it
Fed.
this way. Think of it this way. You're in a box, and something has to break. One side has to break, and you're not sure
Correct,
which
right,
side that is.
right.
And with thank you. And what something's got to break, and could the government, with interest rates go up dramatically? That was one of the things, with tremendous amount of supply, with multi-trillion-dollar deficits, and interest rates really didn't go up because the Fed was there and monetizing the debt. You got to call it what it is. But
Yeah.
what they didn't anticipate is the side of the box that broke was the inflation box.
Yes,
So
right,
MMT, in our opinion, was a failure. It was a failure because even though it didn't stop interest rates from rising much, or at least I think we're just starting to see that reverse. But what it did is it allowed inflation out of the box, and that's where the Fed blew it.
Yeah,
Yeah, and-
no one seemed to have that consequence. Was like, you look at MMT, they said this concept seemed to be ridiculous, that you would think, even on the surface, but then it was taken very seriously. But it was clear that there was an inflation risk of that whole thing, and sure enough, it came up.
Well, it's like whistling past a graveyard. I saw a comment today from Stiefel saying that one concern as far as equity valuation and probably all risk assets is the fact that we may see an increase in real yields. I'm saying to myself, wait a minute though, if based on lagging inflation, real yields are minus 5%, right? To say that the market cannot withstand an adjustment higher of that rate sounds very, very concerning, right? You mean the market cannot function properly and valuations can't be supported with a real yield of maybe minus 2% or whatever? I mean, right now, real yields are in 5 years. The real yield, anywhere 5-year notes right now, like 150, right? 140?
No,
No,
Less.
lower.
165,
look,
165.
Okay,
if you
so
go back,
okay.
if you
Okay,
go
so
back to 1984, go back to 1984, where inflation was what it is now, which is like 7%.
Yeah, you were at 9%, 10%.
Yeah, exactly.
10%,
Right,
10%,
right,
10%, 10-year.
right. That's
So
right.
that
Yeah,
was the real yield of 3%. Now you got the same inflation rate,
right.
and
Yeah,
10
right.
years at 1.8.
Okay. Okay. Here's
So
the picture.
Armand, what's the difference? Armand, what's the difference? And I'll tell you what the difference
It's
is.
financial. It's
No,
financial
no,
repression. It's financial repression.
Well, no,
Keeping
I'll
rates
tell you
low.
what it is.
Well,
There was an
financial
article.
repression,
Yeah.
that is true.
I
But
think
you know what? In 1984, the Fed wasn't in there buying everything that wasn't nailed to the wall.
Correct.
And in 2020, listen, I think Powell was a genius in what he did in March in 2020. The economy we were just about to plummet into a real recession, depression, whatever, and he brought rates down in two moves, whatever, down to zero, and he kept them there. And he had the Fed, and he was able to convince, talk about fiscal. He was able to convince the Congress or the Treasury to give him the opportunity to buy bonds and support bonds. He changed the corporate bond market by only buying 12 or 14 billion of bonds in a multi-trillion-dollar market. But the perception that the Fed was going to be there, he was a genius. The problem is in 2021, when he had the opportunity to start to reverse this, he didn't want to do it.
Yeah, right.
Yeah. Well, here's a picture of real yield in 10 years, right? So we're at minus 0.6, right? Okay. So yes. So on the basis of inflation index bond, the real yield is minus 0.6. But as Armand said, based on trailing inflation, it's much, much more negative, right? So, who's right, who's wrong, right? Okay. So now I know we only have about maybe 5 minutes left. So let's quickly pivot to risk product. And for that, as a fixed income guy, I think about, corporates, mortgages, right? So Andy alluded to the performance of corporates. Here's a picture, right, of investment grade credit. We saw what happened immediately after the pandemic materialized. But, we're very, very expensive levels, high yield. similarly, right? Dramatic recovery back to significantly tighter than we were, let's say, in 2019. So how much of these given up? Well, I looked it up, and for high yield, it's about 40. The index is about 40 cheaper. Now, in the environment of higher rates, less accommodation, balance sheet reduction, is 40 an adequate repricing, Andy, of high yield?
Not even close.
Not even
Not even,
close. Okay,
not even
right. Okay,
close.
not even close. Right. Okay. Now on the equity side, on the investment on the IG side, a little bit softer, not dramatic. Right. Now, what happened with the IG side? Well, a lot of issuance early part of this year. Why? Take advantage of low rates, expensive spreads. Right. So what a little bit that I read about this, it said that the pricing levels were pretty strong, right, Andy? In the what's paper that's been originated this
Pricing
year.
levels are still pretty strong. Demand's
Exactly right.
pretty
Yeah.
strong. I
Right.
mean, today Goldman priced a $12 billion deal, and Stanley priced, I don't know how much, maybe a $6 billion, maybe a couple of tranches.
Right.
Yesterday it was all banks, but last week, you were only expecting 35 billion, and I think you priced,
Right.
75 billion and whatever. The demand is still off the charts for corporate new issues.
Exactly. That's right. Yeah, right. On the mortgage side, I talked to my friend who's a mortgage strategist in California. He said that yes, we the positive for mortgage valuations is a lot of refinances were done last year. So this year we might have a little bit softer, a little bit more moderate supply, right? Affordability is stretched, obviously, with Armand said 90% increase in housing prices, right? It's going to get more so because of higher rates. Right. So we will have some refinancing, but it will probably be people are taking out equity. Overall universe of investors in mortgages are less levered than they were years ago. So what he said in summary is, yes, we are wider. Here's a picture. Right. We are wider, but it's been an orderly repricing to wider levels. So, this is the LIBOR, this is the Bloomberg's OAS of mortgages. So they're about, 40 cheaper than they were, but this is still not a cheap level, right? More could leak wider, right? Depending on how much the Fed aggressively sells down their mortgage portfolio. Finally, for the dollar, well, Andy mentioned this. The stock of non-negative yielding sovereign debt is now under 10 trillion, right, Andy?
Yeah, I did see that, a headline in the FT, and I'm
Yeah,
sure that
exactly.
number has
Right,
been reduced since the
right,
article came out.
And the dollar is stronger, right? Not surprisingly, because of probably better U.S. growth and, of course, the fact that we're in a early to begin tightening cycle. So those are the kind of the two big, related markets that hopefully take direction from rates. Sometimes more, they're driven more by rates, sometimes less by rates, but no matter how you slice it, there's an impact of what's going on in rate space on these other markets, right?
Leon, I want to finish your thought, but I want
Yeah.
to get back to that mortgage chart, because I just have the latest one.
Okay.
And I think you have to look at it a little differently. I mean, I work, Rick Santelli tells me, Andy, you work with percentages too much, but I like percentages. So on this, you've moved since January 3rd, which is the first day of the year, you've moved from about 10 to 40 on this OAS thing. So, Leon, that's 4 times, what you were. And if you look at this thing back in May, you were at minus 20. So what it is it's not so much, that mortgages are doing one thing or another, or housing prices. It's all about the Fed. The perception that the Fed is going to back away, is backing away, and it's going to back away even more. This is a perfect example of where the Fed, maybe not purposely, or maybe they did it purposely, manipulated markets to the point where they basically got everyone out of the industry because people couldn't make money in this, or they had to make money in more esoteric mortgages. And I think they've hurt the market. And now the risk is no longer going to be borne in 2022 by the Fed, who doesn't care about convexity risk and doesn't care about how much money they make or lose. And that risk is now going to be put back to the street, who has capital available to them in fixed income at probably 15% of what it was over the last 10 years. So you're all of a sudden, you're going to have all the risk being on the shoulders of people that don't have the capital for it, because the Fed had manipulated the markets for so long, which is part of the liquidity quandary, and I'm a little worried. And I'll leave it
Yeah,
there.
yeah. I mean, that point is very important because again, the experts look at. Andy mentioned the convexity, which of course is a very, very big component of the willingness and at what level the private investors will take on mortgage risk. Now, when they look at this, they look at things like the composition of outstanding product across coupons, moneyness of the refinancing options, stuff like that. My friend's view when I spoke to him last week was, yes, you are talking about a universe of buyers that have to worry about extension risk, have to worry about the fact that they could underappreciate the fact that this paper could widen on a bond market sell-off. But it didn't appear to be, top of the list risk, maybe because of the configuration of the outstanding product out there, maybe the fact that a lot of the cuspier product, the loans already have been refinanced through the 2001 refinancing boom. But you're exactly right. I mean, it would be very, very dangerous to make any kind of judgment call on where mortgages should be in valuation without appreciating these intrinsic aspects of the way the private markets, whether they're, dealers or, real money or REITs or whatever, appreciate this, the fundamental complexity of the asset class. Right. And of course, the OAS is trying to presumably adjust for all those things. That's why it's an objective number. But of course, you have to defend it from the point of view of, believing the underlying modeling assumptions in the number. But in any event, I totally agree with you that it's a very, very different ball of wax to try to understand what's the normative level of mortgages when you're not buying 40 billion a month by a buyer who doesn't care about valuation. Basically is what you're saying, Andy, right?
That's right.
All right. I'm sorry we ran over about 15 minutes. Thank you for your attention. We're willing to entertain questions or comments or challenges of any type. So let's open it up then.
Leon, why don't you take the charts away so we
Yes,
can
we'll do
we
that.
can get everyone, we can see everyone.
We'll do that.
And if there are no questions, we'll do our best.
Any questions?
Yeah, is there a difference between the Fed just not refinancing and letting things roll off and them actively selling off holdings?
I think there's a very big difference in that. And I think that you've hit it right. I don't think the Fed is going to be actively selling, at least as we start. I think the Fed is going to let things roll off. I think they're going to cap how much that, say, let's see if I have this right, because I have a very good friend at the FHFA. Generally speaking, the Fed had been rolling over, never mind the 40 billion a month that they were investing at the peak, but they were rolling over probably another, I don't know, 70 or 80. And I believe that they're going to probably cap that number. And, the 40 original is now probably down to 20 and will probably be at zero within 6 weeks. And then I think the Fed, instead of rolling over 75 to 100, will maybe roll over 40, 50, and thereby reducing their balance sheet by 50. And I think the Fed's going to do similar things in treasuries. But there seems to be a real movement within the Fed to get out of the mortgage book altogether. So I tend to think that they're going to lean in that direction wherever it benefits. But no, I don't see them selling stuff right away.
Yeah, we also have the fact that the agencies, which were an important backstop for mortgage valuation, they're of course less active right now because they're continuing to sell down or reduce their balance sheet and their footprint in the market. I mean, what's sort of amazing is that coming out of 2007-8, because of the meltdown of the private markets, they 70-80% of the mortgage originations were being securitized into agency pools. Right now, there's some evidence of the return of the private label securitization. We've had, strong housing price growth. Credit performance has been very, very strong. We've had, a very, very successful program of the agencies selling their guarantee fee risk into the market through the credit risk transfer programs that have been very successful. So these have all kind of like reinvigorated the concept of how you value mortgage. In fact, somebody mentioned to me at a panel that I moderated back in November that this credit risk transfer market, which didn't exist 8 years ago, has now become the dominant place for private investors to know where are people pricing fundamental risk, credit risk of the generic mortgage borrower. So you want to track what the market thinks is going to be the credit risk of the average person who's buying houses, right? LTV's under 80%, 750 or greater FICO. The place you look is in this CRT market, these M1, M2s, and B bonds, right?
Mhm.
Which is an innovation, because it sort of creates this kind of like this very, very transparent place where people can understand how are people viewing the fundamental integrity of the average mortgage borrower, right? You didn't have to go to complicated, funky mortgage assets to be able to see that. Andy, you want to expand on that?
Yeah, there are a couple things. I mean, I'm looking first at a question that someone put in the chat as to what do I think about housing prices and so on and so forth. So I'm going to take a little bit longer. I look at these markets all the time because I'm basically trying to figure out how to get an edge. And, this sounds silly, but I find that equities are kind of more or less on a 7-year cycle. I started looking at equities in 74, which is downtrend. In 81 was a little bit of a downtrend. 87 was the stock market crash. 94, as Leon mentioned, was higher interest rates. 2001 was the internet bubble. 2008 was the great financial crisis. And I would tend to think based on that 2015 would have been a bad year. But of course, what did 2015 have that other years didn't have? They had a very aggressive Fed come in and basically reprice stuff. So I think equities are more or less on a 7-year cycle. And I'm a little, and now we're back to the 7 years from 2015 to 2022. So we could have a bad year. As far as housing goes, housing, I think, is more or less, and this is just observation. And if Andy Calatay was still on, oh, there he is. If Andy Calatay was still on, he would give me reams of data and I would have to spend days looking through it. But my gut feel tells me that housing's more on a 20-year cycle, that we've been so underproducing housing since the great financial crisis because people are fearful of gluts of houses and so on and so forth. We're so far behind. That's why people are just, bidding through the roof. You'll have in houses that are reasonably priced, you'll have 10 people there, all bidding full price or what have you. I think housing's good for probably another 10 plus years. And I've said this to friends as well. So to answer your question, no, I don't think housing's going to bubble. If housing prices are going up, you don't care whether your mortgage is 2 3/4, 3 1/4, 4 1/4, or even a little bit higher. If you're getting 10 to 12% appreciation per year. I mean, Leon will tell you, since we're exactly the same age, that when we were out there in our first jobs trying to buy a house, the mortgages were 12%. Come on, this is a bargain at 3.5% or 4%. Who knows? You're just at 2 3/4. But I tend to think housing's going to be there for a while.
Yeah, I tend to agree with that. Yeah, I mean, this point about we cannot make up the shortage of required housing in a matter of months. That's clearly a theme. When you speak to people who are sanguine about the housing market, that's one of the key things that they point to. But we can't make it up in a matter of a couple of years. Not even close.
Not even close.
Yeah. Mike, does that answer your question, Mike? Oh, Mike? Oh, maybe he hopped off. Yeah. Okay. Yeah. All right. Great. Any other questions?
To the person that put in the chat, yes, I don't mind my voice being recorded. I don't mind you keeping it, whatever, and so on and so forth. You do whatever you got to do. Make me famous. Make Leon famous. It all works for me.
It's Milind Sharma here, just jumping back in. Thank you for your explicit permission. We have you on record now, so we can post it.
There you go.
We just don't like to record stuff without permission. Actually, I don't know who pushed that button, but I'm glad we did record since you've consented.
So are you gonna have? I had a question from somebody who I sent this link to. They said they can't watch it, but they want to get the recording. Be able to put up a link for where that you can get the video link for the recording.
Yeah, one of my teammates here has actually done a YouTube channel. So we've been thinking of releasing them either just to members with a link or something like that. I mean, do we have our webmaster on here? I don't see Gotham, but maybe Krishna or
Well,
somebody.
yeah, you can do a all the videos are private, and then all you do is you have to say if anybody with a link can
Right.
view it. So you can still have
Yeah.
the YouTube.
Not
That's
everybody
that's
wants
the
to
best way to
publish.
do it. Yeah, you just send the link out to the people, but the video won't appear in any search on YouTube.
Right.
So it's
We
a private
have
video.
a channel, and I believe that's actually how we've done it in the past. Isaac's actually the guy who's done it, so I'm going to ask him to post this since we've got the permission. And if the speakers are fine, we can also post the PDF. I don't think I have your slides. If you don't mind just sending it to us.
Sure, will do. Absolutely.
And I have to say, Leon, I'm glad you talked me into this, because we haven't done a lot of these sort of very market related panels, but this was fantastic. This was such a topical discussion that I think we should have more of these. We've been having a lot more of the academic kind of theoretical ones, but this really was very germane to what's going on in the market. So let me ask you folks this. I mean, and I love, all the detail that both of you went through, since, being an equity guy, I don't spend enough time thinking about trades, and I don't hear the chatter I used to when I was on the floor at Deutsche or Merrill. So I'm curious, I mean, based on the data you presented, it sounds like one should be a lot more bearish. I mean, at least in my view, from what you're telling me, I'm seeing bubbles in spread products and high yield, and obviously the 40-year bull run and fixed income's over. So yes, you may have a perverse sort of flight to safety in treasuries, perhaps at some point when this gets really nasty. But talking about all risk assets, particularly stocks that look very bubblicious in many sectors, and most of all, the mother of all bubbles, cryptos.
Let me answer that at least a little bit. I don't want to sound overly bearish. I do think we have more downside in equities, but I don't think we hit the 20% bear, or if we do, we do. I have in my own mind goals of buying at 15% down, because I think the economy is going to be fine. I think the Fed's on the case. I don't think the Fed's going to be as aggressive as the market, basically pivoted in the last 3 weeks. As far as crypto, I'm not a fan. I do not own crypto. I don't see how to value crypto. I mean, if it's, gold for years, people would call it whatever they want, but it was basically an anti-dollar play. It was an inverse to the dollar. The dollar would go up, gold would go down. The dollar would go down, gold would go up. Gold is taking a second fiddle to crypto because that speculative money is in crypto. And while there are many countries out there where people are trying to get their money out, Venezuela, Turkey, I'm sure many of the Middle Eastern countries, I don't see what crypto is based on. And I just, granted, if you bought it at 10 and you sold it at 60, you're a genius, but I don't see it as being a long-term asset, and I'm not investing. I don't know if Leon is or not. That's up to him.
I'm not, but I mean, the thing that shocks me of crypto is the following, right? That it just seems like the market consensus was, don't think of it as an inflation hedge. So that reason to buy it evaporated, but it kept on going up. You know what I mean? You would think that if kind of a traditional rationale for it, right, is all of a sudden discredited, shouldn't that be a negative for its performance?
There's also the problem now that the crypto, is tracking the Dow, which it really shouldn't have been. And now it's acting more like a high risk tech stock, which was not what also was supposed to be doing. So it's not even an inflation hedge,
right?
And it's tracking the Nasdaq and the Dow. It's tracking it's looking like a high risk equity investment. So, actually, if you look at the correlation, there was a chart that came out that showed it was basically around zero, for a while, and then all of a sudden now it's gone to, like 0.5 correlation
with equities.
Yeah, so it's not a good hedge, against, the equity market. So that's a problem now too.
Milan, does Kathy Wood have an opinion on crypto? I'm just curious.
Of course, she loves Bitcoin. She loves Tesla. She thinks that we're going to get deflation, not inflation.
So she's buying it. Wait a minute. But why would wait a minute though? You mean she's buying it because she doesn't think there's any connection to inflation, but there's got intrinsic value for other reasons? Is that what you're saying?
The cult followers always, and Leon, I think there may be a bit of a generational divide amongst participants who are above 35 versus below 35. I'm not as young as I look, so I'm with you on this one. I don't see any intrinsic value. I don't see any scarcity value. All the arguments that I tend to hear seem like complete utter nonsense, because the truth is you can create 1,000 of these coins. So when people say, "Oh, Bitcoin is scarce," that's utter nonsense. You can fork them, you can replicate them, you can create as many tokens or whatever you want. So
there was a news item. Actually, Barron's had a piece today that came out that actually valued. There was somebody did a study and using some network effects and said Bitcoin should be worth about 20,000. And the article said that this is the first time they've seen some kind of a real valuation thing. And it's just you should see it. If you go online, the Barron's site, there's a an article says a Bitcoin is worth half what it's trading for.
But I mean, Charlie Munger had a very concise sort of valuation of it, which I won't repeat. But the point is, look, it's a cult following, and putting that aside, I mean, my real point was that the reason one could be more bearish is because of the reverse, the Fed going in reverse. You get the negative wealth effect, and as one of the bubbles starts deflating, I mean, you can see that actually in crypto land with Ethereum, with Bitcoin, all these things are suddenly down 30-40%, and then you see this, the archetype of names are down 70-80%. And there is no support. I don't see the dip buyers coming in. I mean, in fact, today, Mike Novogratz, who's sort of one of the few.
A big sponsor of crypto, right? Big advocate.
So Novogratz, who I would respect as a very astute individual in that space, is actually all of a sudden bearish. He's saying that, with the 10-year creeping up, but that's obvious. There's an obvious inverse correlation between, risk assets and. So I would be very bearish, because I think, we saw the extreme inflation of so many massive bubbles. And after 13 years of so much of the Fed's largesse and excesses being pumped up, I mean, why would we think this is going to stop here?
But it's weird, because, I used to believe that whenever you had any evidence, like in the last 13 years, let's say, right? I used to believe that, well, how much of where we are in valuations, I don't care what it is, whether it's credit, high yield, equities, whatever, I would say how much of that is being unnaturally supported by incredibly cheap funding and tremendous availability. But I started to get the impression that people much smarter than me started discounting that. They said, you can't put valuations that are so high at the doorstep of, because a hedge fund can borrow X% money, an unlimited amount, or an LBO can be executed, that there are other reasons, whether it's innovation, productivity, or whatever. And I started believing it myself, the fact that it wasn't just simply cheap leverage that was fueling unnaturally high valuations, right? Now, maybe people will revisit that and say, yes, it really was that, right? As we push rates, we have a 2 or 3% funds rate and bond yields. I don't know. Andy's saying 3.5. We may reprice. I'm not so sure people believe that. Not sure people believe. They think that there were more valid reasons for where prices were at than just simply saying that, borrowers could literally lever up really cheaply. Now, again, I get the feeling that people were sort of like, they felt, no, there were more legitimate reasons for the valuation levels than just simply, because funding is cheap. I don't know. What do people think about that?
Well, I'm curious, because Andy Brenner mentioned 15% as his sort of buy the dip. But
doesn't always work.
But unless you think the Fed's going to blink again, like in December 18, right? I mean, the point is, unless the Fed's going to blink all of a sudden and do a U-turn, what's stopping this downdraft, right? So on the way up, as the balance sheet was expanding, people bought into that correlation argument that, well, it's almost a perfect correlation between the expansion of the balance sheet and the equity markets. Now, however, I will mention a caveat that does not appear to be true in Japan and Europe. Maybe you can tell me why. I don't understand that fact. But in the U.S., it does look like that's been a pretty tight correlation. So if it worked on the way up, why should it not work on the way down?
Yeah, that's the picture I showed of what happened in 2008. I'm sorry, 18 kind of reinforces that, right? You know, there was talk of a reduction in the balance sheet, and we saw the equity market basically move sideways, right?
Well, and in 13, I believe, right? Was it the taper tantrum 13?
Yes, yeah. Taper tantrum was significant damage to both equity. Well, not so much I think actually taper tantrum really affected structure more, you know, even kind of plain vanilla stuff, you know, not so much equities, I think, frankly. I think structure was hurt more, you know. I mean, but to give you the idea of like structure, I'll give you one little data point, which you might find interesting, right? Okay. So we had a convulsion in structured product in 1998 with the Russian default. Okay. The most plain vanilla, simple credit card asset-backed security, let's say a 3-year average life, may have been LIBOR plus, swaps plus 15 or 20. That paper widened to about plus 50 in the 1998 crisis. Compare this to 2008. The most plain vanilla, money good, AAA structured bond went from LIBOR plus 20 to plus 350. So the bond dropped by about 10 points in price. A bond that everybody would have believed would never miss a coupon or principal payment. Why? Because everybody was selling structure in favor of buying. Well, we talked about this, right? The migration towards, safe assets, right? Now, I don't think we're going to get a repeat of that now, in part because I think the credit universe is much, much stronger right now, whether it's in mortgage land or consumer credit land, and even in corporate land, despite the massive increase in leverage, I think the support of, strong earnings is offsetting that. So I don't think we're anywhere near that kind of situation, right? And the old situation wasn't even fundamental. It was basically a question of, the paper was being held in weak levered hands who had to sell. Andy, would you agree with that? In a way?
I would, Leon. I think that the difference is, or one of the differences is that there's a lot of money out there. And even with the Fed starting to take stuff back, there's still a lot of money out there. And I think the economy is going to continue to chug along. I really think there are shortages, and those shortages and those higher prices are getting pushed through. So I don't see a huge correction happening. It could happen. I don't think this is 2007 or 8. I think housing is fine, and I don't see that big a correction. If I'm wrong, I'm wrong. Then we buy a little bit more at 20%. But I made the decision basically not to sell much in the last half of the year. Sell basically stuff that appreciated and whatever, because you're talking about a 30 or 40% tax hit. And, I felt with the 30% tax hit, I would have to have a correction of at least 25% in order to just bear that out. So, I got plenty of cash on the sidelines. Question is, how do I want to deploy it? I will tell you something else, and this really didn't come up today, is I think there's much more value in private equity and venture capital than there is in listed equities right now.
Alon, do you have an opinion about that? The private markets are the part of the place to be.
I mean, look at the universities, look at the endowments. I mean,
I know it's amazing, isn't it?
Brown was over 50%, and Harvard was the weakling. I know Penn was up in the 40s, and even what CalPERS, they're looking more, they're devoting more and more to private equity and venture capital.
Right.
Yeah. By the way,
We'll
regarding just a little observation about the future talks, Milan mentioned more market theme talks. My friend Bill Berliner will speak probably in April. give an
Yeah.
overview of what's going on in mortgage space. He's one of my close friends who's a real expert. So I think our audience will find that interesting as well, Milan.
No, that's a good idea. Definitely will follow up with you. Thank you for leading the charge there. We were fortunate to have Leon's input on speaker selection.
I think one thing you got to do, I think all these seminars, you have to sort of not have anybody talk about yield curve models because they're basically useless. You know, I always say what's happened to the treasury curve is what happened to astronomy back in 1915 when Hubble discovered Andromeda Galaxy.
Yeah.
So all the textbooks have to be rewritten because people thought the universe was just the Milky Way, right? So I think ever since this QT and QE, all these bond models that are in textbooks are basically have to be thrown in the garbage. So my view is any kind of 2-factor, 3-factor discussion about stochastic factors is, to me, it's just like it's useless.
I remember spending many hours at a previous job tweaking a multi-factor model to make sure rates could never go negative.
Well, negative, right? Well, look, why do you
Right.
think people asked you in the 80s, why do you use log normal rates? Because it can't go negative. Oh, of course, that makes sense. That's why I use log normal. So that whole theory is out the window. So everything about the treasury market in terms of the academic side of it seems to be just simply has to be rewritten or discarded, I think. But no one will do it because no one wants to admit that. But that's the fact, I think. And this is someone who's doing yield curve stuff for 40 years, like myself. So anyway.
Well, guys, I'm starting to get a little tired. So if there's
Yeah.
nothing else, I'd like to sign off, and I'll be more than happy to do any more of these. If you want current stuff, I'll be more than willing to put anyone on my daily commentary, my morning commentary. So please let me know.
Same on
Thanks,
my
Andy.
end. Feel
Thank
free to
you.
reach out to us.
Thanks.
Milan,
Thanks a
thank
lot.
you again for logistically setting this up. And we really, both Andy and I really enjoyed, interacting with the audience.
Absolutely. This was fantastic. Thank you so much. And I want to point out that normally we take speakers out for dinner, so we owe you that one due to Omicron. I'm not sure we're going to do that tonight. But
Take a rain check.
yes, absolutely. And maybe we'll have more festive crowd with your friend Bill in April, perhaps. By that, I think this should have subsided. And I'll be back from Miami. I'm also going to be decamping too. So one final housekeeping note, just a reminder to everybody that we're going to have Greg Zuckerman next time. He spoke last year on his book about Jim Simons, and that was very well attended. We had a live sort of book signing here at the Francis Tavern next door. So that's been our go-to place, and that was fantastic. Unfortunately, this time we can't do a live book signing, but as you know, he's got a new book out about the vaccine, the shot that saved the world. So it's a really great book. I just read it on the plane from California. It's beautiful, sort of very detailed story of Moderna, Novavax, and BioNTech. So couldn't be more topical. It's not really maybe as much finance, but for quants, I think it's very topical to hear that story.
I'm sure it'll be wonderful. Looking forward to it very much.
Thank you. So I hope to see all of you again next time. It was wonderful to hear Professor Ablanita in the background, Andy Calte, so many new people that we just saw today. Thank you, everyone, for coming.
Thank you,
very
everybody,
good.
for listening.
Thank
We really
you.
appreciate your
Very
attention.
much.
Thank you very much.
Thanks.
Take care, guys.
Bye-bye.
Good night. Bye-bye.
Bye-bye.